What if I told you that the money in your pocket isn't controlled by your government? That every dollar, euro, or pound you earn exists because someone, somewhere, decided to create it as debt? Most people never question where money actually comes from. They assume governments print it, spend it, and that's that. But the truth is far stranger. In 1913, a small group of men met in secret on Jekyll Island, off the coast of Georgia. They represented 1/4 of the world's wealth. 10 days later, they drafted a plan that would reshape the entire global economy. That plan became the Federal Reserve System. But here's what most people don't understand. The Federal Reserve isn't federal, and it has no reserves. It's a private institution with public authority. And the model it created has been copied by nearly every nation on Earth. This is the story of how central banks became the most powerful institutions you've never truly questioned. Before 1913, the United States had no central bank. The country had tried twice before. The first Bank of the United States was chartered in 1791 but expired in 1811. The second bank followed in 1816 but was killed by Andrew Jackson in 1836. For nearly 80 years after that, America operated without a central authority controlling money. But by the early 1900s, financial panics were becoming more frequent. The Panic of 1907 was particularly severe. Banks failed. Markets collapsed. J.P. Morgan himself had to organize private rescues to prevent total disaster. The crisis convinced many that America needed a lender of last resort, a stabilizing force. What they got was something far more complex. The meeting on Jekyll Island was organized under the pretense of a duck hunting trip. Senator Nelson Aldrich, a powerful Republican, invited 6 men: A. Piatt Andrew, Frank Vanderlip, Henry Davison, Charles Norton, Benjamin Strong, and Paul Warburg. Together, they drafted what would become the Federal Reserve Act. It passed Congress on December 23, 1913, when many members were already home for Christmas. So what exactly is a central bank? At its core, it's an institution that manages a nation's currency, money supply, and interest rates. But the structure reveals something more unusual. The Federal Reserve is technically a hybrid. It has a board of governors appointed by the president, but it also has 12 regional reserve banks that are owned by private member banks. These member banks hold stock in their regional Fed bank. They receive dividends. Yet the system operates with government-granted authority. Here's the key mechanism. Central banks control the supply of money, but they do not print it freely and hand it to governments. Instead, governments issue bonds, essentially IOUs, and the central bank purchases those bonds with newly created money. The government must pay interest on that debt. This means that when a government needs money, it borrows it into existence and pays interest to do so, even though the money was created from nothing. This raises an uncomfortable question. Why does a government borrow money it could theoretically create itself? The answer lies in control. By separating money creation from political decision-making, central banks claim to protect currency from short-term political pressures. Politicians might print money to fund wars or buy votes. A central bank, insulated from elections, can say no. It can raise interest rates even when it's unpopular. It can contract the money supply to fight inflation even during a recession. But this independence comes with its own problem: accountability. Central banks are not elected. Their meetings are often closed. Their decision-making is opaque, and their actions affect billions of people. When the Federal Reserve raises interest rates, it influences the cost of mortgages, business loans, and government debt across the entire economy. Yet voters have no direct say. The consequence of this system is a subtle redistribution of power. Debt becomes permanent. Since money is loaned into existence, the total debt in the system is always greater than the total money supply. There is always more owed than exists. This creates a structural need for perpetual growth. Economies must expand to service existing debt and create new money to replace old loans being paid off. Nations that adopt this model lose a degree of sovereignty. They cannot simply spend without borrowing. They cannot inflate away debt without consequences, because inflation erodes trust in the currency itself. And in a globalized economy, trust is everything. A government that loses the confidence of bond markets faces capital flight, currency collapse, and economic isolation. Central banks also gained enormous power during crises. The 2008 financial crisis demonstrated this clearly. The Federal Reserve, along with the European Central Bank and others, created trillions of dollars in new money through programs like quantitative easing. They purchased government bonds, mortgage-backed securities, and corporate debt. These decisions were made by unelected officials, yet they reshaped the global economy. Asset prices soared, inequality widened, and the banking system, which had caused the crisis, was preserved almost entirely intact. Central banks had become the ultimate backstop, not just for currencies, but for entire financial systems. They were too powerful to fail because the system had become dependent on their intervention. Today, nearly every developed nation operates under a central banking model. The European Central Bank controls monetary policy for 19 countries. The Bank of Japan holds government bonds worth more than the country's entire GDP. The People's Bank of China manages the world's second largest economy with a unique blend of state control and central bank mechanics. These institutions set the price of money itself. They decide what it costs to borrow, which influences what it costs to build, hire, and invest. When central banks coordinate, as they did during the COVID-19 pandemic, they can flood the global economy with liquidity almost overnight. When they tighten, as they did in 2022 and 2023, they can trigger recessions, collapse asset bubbles, and destroy trillions in wealth. Yet most people never think about them. Central banks operate in the background. Their power so normalized it becomes invisible. But that power is real. It shapes employment, inflation, savings, and the distribution of wealth across generations. And it all traces back to a decision made over a century ago that money should be controlled not by governments directly, but by institutions insulated from democratic pressure. The Jekyll Island meeting lasted 10 days. The system it created has lasted over a century. Whether that system serves the public good or concentrates power in unaccountable hands remains one of the most important questions in modern economics. And it's a question that affects you every single day, whether you realize it or not.